Let's talk about mortgage types. Fixed rates, adjustable rates, FHA, USDA, conventional, VA, down payment assistance, local grants. How do you know which loan program is best for you? Which mortgage is more favorable depending on the type of property that you're buying? If those are some looming questions in your head, you have picked the right episode to tune in today. My name is LaShawn Abraham. I am a branch manager and mortgage loan officer here in the cold, freezing Summerville, South Carolina, where we're expecting some snow this week. And so I am joined with my partners here, Mr. Abraham and Mr. Barry. If y'all want to do introduction, because I can't wait to talk about this topic today.
Nah, I think that our loyal tuners have they know who we are. But Gavin Abraham, also loan officer here in South Carolina, North Carolina, and Georgia. So let's
Yeah,
get
we
to
can
it.
get right into it. We can get right into it, Gavin, and LaShawn. I'm pretty sure they know us by now, right?
Good,
Should know it.
yeah. They should. It's only
Yeah.
been we're doing this for what, going in our second year
Okay.
consecutively. So I'm super
Yeah.
excited about it. So let's just jump right in. So when it comes to mortgage types, there's so many different ones, right? And
Mm-hmm.
sometimes I think sometimes people may have their own preconceived notion of, especially like granted, if you're in the military, you serve, we want to thank you for your service. Most people say, I want a VA loan. Like I know that's the type of loan that I need. Or if you don't kind of fall in those special class services, then sometimes you just don't know. You don't know, should I do an FHA loan or should I go with USDA? So let's kind of talk about that because I don't know, guys, have you experienced any of that where people may either have their mindset on one thing, but once they speak to a lender or once they kind of go through the process, that may have changed?
Yeah, I think we experience, people have that those conversations with other people who bought homes and
Mm-hmm.
they're like, yeah, I want a conventional loan or I want the USDA loan. And sometimes it's just not the best fit for you.
Mm,
You have people in the military that don't know that they truly qualify for a VA loan, which could be more to their benefit as opposed to going conventional or FHA. So absolutely, people have we get people sometimes that think they know what they want, and then we just have to present them with their options and truly hone in to say, hey, this is going to benefit you better. This loan type is more geared to what you're needing to purchase a home in today's market.
right. I'm glad you talked about that because I think it's important for people to understand that, when they come and they talk to you guys about a home loan, that you guys have more than just one product, right?
Mm-hmm.
Mm-hmm.
You have products to fit their needs. And you might even have something to better fit them better than what they think they might need or what. So, like, I know some people out there, they didn't know that there was a no money down payment loan. They just thought, hey, you just had your conventional loans. And I'm glad we're talking about this topic
Mm-hmm.
today. So, yeah.
Yeah, so let's kind of get right into. Let's start it off back. I know a lot of times when I ask people what type of loan they want, one of the main questions they or comments they may say is, "I want to make sure my rate is fixed. I want my rate to be fixed, right?" And so that's a type of loan. A fixed rate mortgage is a type of loan. And so why would a person want that type of loan? You may ask, is because fixed rate loans tend to bring you more stability, right? So for those who don't want to take the risk of their payment increasing after a period of time, or maybe they're on a fixed income or want to make sure they stay within their budget, they may seek a fixed rate mortgage. But however, what you may not know for fixed rate mortgages is those rates tend to be a little bit higher than something called like an adjustable rate mortgage or something where you may do a temporary buy down, that you kind of tack on to it. So kind of like, once again, back to the beginning of, what we just said, depending on what type of loan you need, right?
Mm-hmm.
Everybody have their wants and they have their needs, but sometimes you may think you need something, but you may really need something else. And so being able to kind of explain these different loan types to you is super important, because it may be a better fit to do an adjustable rate mortgage versus doing a fixed rate. I think adjustable rate mortgages kind of get a bad rap a little bit because
Hmm.
people don't quite understand them because they, you know, they tend to have,
Mhm.
people think that they caused problems that, when the market crashed back in 2008, 2009, but that's
Right.
not necessarily so. I think once, if you're educated enough on them, generally there are people that truly may choose an adjustable rate over a fixed rate mortgage.
Yeah, I mean, when we bought our first home, we chose
Second home. 1 second. The
we
second
didn't
home.
choose my second home. When we bought our second home, we chose, yes, you're correct. We chose an adjustable rate mortgage, because we knew uh, that we were probably going to buy or we're going to buy again or possibly sell that home, within a short time frame, which we did. We turned it around in 3 years, and then we, bought another home. So we were okay with having that fixed interest rate, a more introductory rate, which may have been a little bit, a tad bit lower than where fixed rates were at the time, so that we can have a lower payment, and still be fine, before the adjustment takes place on the arm. And I think we did a 7-year arm, if I'm not mistaken. And yeah, so the whole mentality behind the whole arm is just knowing when your adjustment period ends. And if you're gonna be taking advantage of that lower that lower interest rate, then just be prepared to know that, hey, how are rates looking, as I approach my final year? Is now a good time? I know that my current loan is going to either adjust to where market is going to either be higher, or what, rates are lower. So you know what, I may be fine. But having those conversations with your professionals to make sure that ARM is a good choice for you.
So let
But
me ask you a question, if you don't mind,
yeah, jump
butting
in.
in, Gavin. So with that arm, let's just say, with the adjustable rate, um, right now is lower than, is it always going to be lower than your fixed rate? No.
No, that's a
Okay.
really good question.
Mhm.
No,
Yeah.
not necessarily. It depends on, it's honestly, it depends on the market and the timing. So for us, when Gavin and I bought, that second home, that would have been back in what, 2021? No, yeah, I would say somewhere between
No,
2018 and,
yeah, 18.
yeah,
20.
2018 to 2021 is when we sold it. At that time, rates were, 4 or 5%. And so
Mm.
we were able to get an adjustable rate mortgage where our rate was like 2.5 or
Wow.
something crazy for like the first 7 years. And so for us, that was great. And at the time, based on what the market was doing, a lot of lenders in the economy was trying to readjust itself and do some other things. Now, today in 2025, arms are not priced like that anymore because rates
Mm.
right now are still 6.5, 7%. You
Mhm.
might find on an arm that the rate may be 5, even maybe low sixes. And
Mm.
some people may say, that's not low enough for me to take that type of risk. You won't find today where you can get an arm again for 2% when rates are at 7, 8% right now. So it just kind of depends on the timing. So not necessarily, but sometimes in some cases, they really, really are. Typically, the shorter the term, the lower, that rate tend to be. So like if you, opted to maybe do a 2 or 3 year or even a 5-year adjustable rate mortgage, then you may see that rate a lot lower than what it would be on like a 30-year fix. Same thing with the 15-year mortgage. If you got a 15-year mortgage over a 30-year mortgage, that rate would be a lot lower too.
Right. Okay. Great.
So yeah, so let's get into number 3. We kind of combine fixed rates and adjustable rates. FHA, I think FHA is definitely a more favorable loan, but I don't know. I feel like I think FHA kind of gets a little bit of a bad rap. I mean, you tell me, Wilmot, like when you have a seller and you getting offer, if somebody has a conventional offer letter versus someone who has an FHA offer letter, do you tend to think that people lean more towards conventional versus like a government loan like FHA? Have you had any sellers kind of be a little picky?
Yeah. So it depends on the situation, right?
Mhm.
If let's just say you have multiple offer situation, right?
Mhm,
And someone brings a conventional loan with the same terms
mhm,
as you have another buyer with an FHA loan with the same terms, right? Same price, same everything. Okay.
Appreciate you, fella.
Yeah, I see Jeremy. Yeah, and one of the things that comes up from the seller is, okay, well, tell me the difference between what loans may require when it comes to the house. Okay, your
Mhm.
conventional loans are going to be more lenient as far as what certain things have to be in the house, what standards that loan has compared to, or requirements that loans has compared to your, like your FHA loan, your USDA loan, or your VA loan. Okay, just to give you an example, something you might think is very simple, like chip and paint, right? That's
Mhm.
going to pop up on a FHA loan appraisal. Okay. When that appraisal comes out, and he tries to appraise the home, he's going to actually do a more thorough inspection type appraisal than your conventional loan.
Mhm.
Okay. There are certain requirements
There you go.
that that loan has to have for that home, and you can't just buy any home with a FHA loan, USDA loan, and VA loan because of those stricter requirements with those particular loans. So,
And
to answer your question, I know that was
mhm.
a long answer.
Nah.
Answer your question. The seller, the seller may lean more towards that conventional loan more so than the FHA loan, because they may feel like, hey, the FHA loan may require me to do more repairs. Okay,
Mhm.
if that makes sense.
Yeah, absolutely. I don't know if he's going to say something, Gavin. I want to jump in and answer Brian's question. He did ask the question
Okay.
on what's the difference between FHA versus USDA, which is a great question,
Great
because
question.
even though they're both government-backed loans, they have completely different guidelines.
Mhm.
So FHA is typically your more favorable loan for a lot of first-time home buyers because they have a lot more leniency when it comes to credit. To be honest, you can get an FHA loan, down to, depending on the lender, anywhere from 500 to 540, 580 is kind of their sweet spot. On a USDA loan, not happening. Typically, they want you to have a little bit more better credit, usually starting around the 600 mark. USDA is specific for rural areas. So
Mm,
for like areas like Orangeburg, for now, is considered rural, but I think
right.
eventually the city of Orangeburg will probably not be rural just because of the growth that is happening. But currently, a lot of Orangeburg County is rural housing. And then also, USDA is based on income in your household size when FHA is not. So typically, you have to meet a certain income bracket, family size, and certain location preferences in order to qualify for USDA loans
Mhm.
versus FHA has none of those restrictions. It's completely open. If you qualify for FHA, you meet the credit score and debt to income ratio requirements, then you're kind of in the door. That's kind of the simpler way to probably explain the
Yeah.
difference between those.
Yeah, I mean, I want to touch on that as well. So, like with USDA, like we get a lot of people who think that USDA is going to be the best option for them,
Mhm.
because they know that they're buying in a rural area, and that's just what they hear from other people. It's like you get your USDA loan, no money, you don't have to put a down payment down. But you know what? LaShawn, you've been doing this a lot longer than I have when I joined, but I've been doing this now for over 3 years, and I have yet to do a USDA loan. And I'll tell you the reason why. It's truly because people, a lot of times in the rural areas, the prices are lower. So you're not, unless you're building your dream home or something of that sort. In most rural areas, the price point is a lot lower, and we have other programs which may carry either a better interest rate and also cover your down payment in full with some leftover to go towards your closing costs.
Mm,
And we
mm,
typically um, help buyers understand that, hey, this program with down payment assistance, as opposed to the USDA program that covers your down payment. Because if you're buying a home at 200,000, right, your down payment on an FHA loan would be 3.5%.
mm,
So my math is wrong, right? It's somewhere around $7,500, right? If for USDA, guess what? That 7,500 will be covered under USDA loan program. But state housing, guess what? They're offering the same or more competitive interest rate for an FHA loan, and they're going to give you $10,000 to go towards your down payment. So guess what? Now I'm taking care of your down payment, and now you have almost $3,000 to help also cover your closing costs. So a lot of times we get, those buyers who, man, I want a USDA loan. Well, let's find out, why do you want that USDA loan when there are loan programs and options that could be more beneficial to you, that have less stricter requirements and offer you more as a buyer.
So can I ask a question?
Yeah.
Are USDA loans and FHA loans only for first-time home buyers?
No, no, they're not. They're not only for first-time home buyers. However, they don't allow you to have more than one USDA or FHA loan at the same time. And they're only for the use of purchasing a primary residence. So if you're not going to live and try to, make that home your primary residence, then typically you can't use those loans for that. But one other thing I was going to add before we wrap up, and we never seem to get through all of our all of our things here, but I did want to point out, because Gavin, you did kind of say something that even though you joined me about 3 years ago and you have yet to do a USDA loan, and there's a reason for that, is that USDA loans are becoming less popular because of as inflation rises and prices rises, those government assisted programs like that becomes a little bit more obsolete because of inflation. A lot of people have a lot more debt than they ever had. When I first got into business back in 2016, I did a ton of USDA loans because rates were lower, prices was lower, it was easier to get it. So one of the other big keys to USDA loans that's different from an FHA loan is the debt to income ratio. And we didn't talk about that. So like on a USDA loan, they typically don't let you borrow more than 41% of what you make. On an FHA loan, you can go up to 55, 56%. And that's a big difference. So when prices are high and people have a lot of debt, a USDA pre-approval versus an FHA pre-approval will be night and day. You can probably get pre-approved to buy a house for $350,000 on an FHA loan, but only get pre-approved on a USDA loan for a house for maybe $200,000, which is a big difference. And when you're in a market where prices are high, rates are high, things like that, it makes it a lot more challenging, depends on where you live, to make that pre-approval work.
Last question before we get off, because I know this might come up with FHA and you. Well, let's look at his question. Is there a price threshold on a house when using FHA or USDA? Okay, not for flips. Can you guys answer that one?
I mean, the answer to that question is yes. FHA, there are sales price limits for FHA loans, loan limits for FHA loans. They have steadily increased with how as inflation increases, they've seen that, we have to do, increase the threshold for what borrowers can buy, because we can't keep the price point, the cap at $350,000 when the housing market is up to $500,000 on average. So they've increased it. I think now we're closer to like 7 almost, or maybe are we that high?
No, that's for conventional. For FHA, I think we're up to we're still about $500,000.
About $500,000.
Typically, you can't buy over $500,000 with an FHA or USDA loan. Typically.
Okay.
So yeah.
All right.
Well, this was such a great session. I'm sorry we couldn't get through all the loan types. We had some great ones. But as always, guys, if there's more things that you want us to talk about and discuss, please feel free to reach out to any one of us. We're more than happy to, bring you guys this education and content. So until next week, you guys have a great day. Stay warm. Hopefully the snow stays away.
Right. You don't gotta go. You don't go ahead and get your milk and your bread now. Don't be trying to don't be trying to go out there and get no Dodgers chicken in the middle of the storm.
Not the Dodgers chicken.
I got you, brother. All right.
Yeah, have a good
have a good one.
All right, later.